On-screen text. This mortgage could save you thousands or cost you your home in 2025. Fast-paced clips. Happy families getting house keys gives. Sudden flashes of foreclosure signs. His interest rate charts spiking. Dramatic music builds tension. On-screen text. ARMs are back and mortgage rates are rising fast. Voiceover. Adjustable rate mortgages or ARMs are back. And the housing market hasn't seen numbers like this in over a decade. The Brickstart logo animates with tagline. Smart moves for smart buyers. Hey everyone, welcome back to Brickstart. It's me. Before we dive in, let me know in the comments. What has been your biggest surprise about the housing market this year? It's been wild. And if you're new to my channel, subscribe because we drop a new video every single week, keeping you in the loop on the smartest moves in real estate and personal finance. All right, now let's get into it. 2025 is shaping up to be a pivotal year for homeowners. Rates are rising and the future looks uncertain. In the midst of this, there's a quiet storm brewing in the housing market, one that could either save you thousands or lead to a nightmare scenario. Adjustable rate mortgages, also known as ARMs, are making a comeback. So here's the deal. As of June 2023, over 25% of new mortgages written in the U.S. were ARMs, which is a jump from just 8% 2 years prior. This trend signals a shift in the market. Buyers are ditching the security of fixed-rate mortgages for the promise of lower initial payments. But don't be fooled. There's a twist. You see, adjustable-rate mortgages offer low introductory rates, usually for a set period, say 3, 5, or 7 years. But once that period ends, the rate adjusts, sometimes shooting up by hundreds or even thousands of dollars a month. So let me break it down for you. Imagine you've got a $2,000 mortgage payment each month. You lock in an ARM. For the next 5 years, you enjoy a fantastic rate and your monthly payment stays low at $2,000. But here's the catch. After 5 years, your rate resets. Suddenly, your payment jumps to $3,200 a month. While this example might seem extreme, it's not unheard of. And the worst part, many borrowers don't realize this until it's too late. So what's fueling this surge in popularity? Well, think about it. Mortgage rates have been climbing. They're currently hovering around 7% for a 30-year fixed-rate mortgage, which is a level we haven't seen since 2000. That's a big deal. So naturally, buyers are hunting for ways to save money. Enter adjustable rate mortgages. With an ARM, you can secure a mortgage with an initial rate that's significantly lower than the current rates. For instance, you might score a 5.5% RM when the fixed rate is sitting at 7%. That's a tempting difference, especially if you're eyeing a bigger home or need a larger loan. Let's take a look at some real numbers. A 30-year fixed-rate mortgage on a $400,000 home at 7% comes out to a monthly payment of $2,800,281. Now, here's the kicker. A $400,000 ARM with an initial rate of 5.5% would mean a payment of $2,211 for the first 7 years. That's almost $600 a month cheaper. It's no wonder so many are jumping at the chance to save money. However, before you jump on the bandwagon, you need to understand the risk. It's like playing a game of financial chicken. You might be able to handle the higher payments for a while. But what happens when the inevitable adjustment occurs and your payments skyrocket? You're essentially betting on the rates staying low. And if they climb, well, you're left holding the bag. Now, if you're planning to refinance before the rate reset, you might think you've got it all under control. But remember, refinancing isn't guaranteed. It's like trying to predict the weather. You can look at all the indicators, but there's no certainty. Plus, when you refinance, you're resetting the clock. You'll only buy yourself a few years before the next potential spike in rates. Then there's the risk of negative equity. Picture this. You bought a home for $400,000 and put $80,000 down. But after a few years of low payments thanks to your arm, you owe $500,000 on a home worth $400,000. You're underwater and refinancing seems impossible. This isn't just a theoretical nightmare. It's a reality for thousands of Americans who locked into ARMs during the boom years, leading up to 2008. During the housing boom, everyone was taking out massive mortgages. Home prices kept climbing, so people felt rich. Then the market shifted. Prices dropped, unemployment rose, and those rock-bottom RA payments suddenly became unaffordable for many. People started to walk away from their homes, leaving behind a wave of foreclosures. It was a financial tsunami, and it's still fresh in the minds of many. Now, I'm not saying we're headed for a repeat of 2008. The market is different. But there are lessons from the past that we must learn. Here's the thing. We're already seeing signs that the housing market is cooling. And if rates continue to rise, we could see more homeowners struggling with their mortgage payments. A recent report by Black Knight Research reveals that nearly 1 million homeowners with mortgage payment increases have less than $20,000 in available equity. Translation: they owe more on their homes than their homes are worth. Add to that, about 1.6 million more borrowers have equity between $20,000 and $50,000. If the housing market takes a downturn, these folks could find themselves underwater and unable to refinance. Now, I know you're probably thinking, me? I'm not going to be one of those people. But remember, life throws curveballs. A job loss, a medical emergency, or a family crisis can turn your financial world upside down. So here's the deal. ARMs aren't inherently bad. They can be a solid financial move if you know the rules, play the odds correctly, and plan for the unexpected. But if you're going down this road, here are 3 golden rules to keep in mind. First, plan your exit strategy. Know when your intro rate ends and have a clear plan for what you do when the rate adjusts. Will you refinance? Can you afford the higher payment? Having a backup plan is key. Second, keep a safety buffer. Don't stretch your payments so thin that you're living paycheck to paycheck. Life happens, and you need room to maneuver financially. Third, educate yourself on the risks. Understand the RM terms inside out. Know the reset frequency, the margin, the index, and any caps on how much your rate can fluctuate. Here's the thing. At Brickstart, we believe in smart homeownership. It's not just about buying a home. It's about building wealth and securing your future. Adjustable rate mortgages can be a tool in your arsenal, but they're not a magic bullet. Don't fall prey to the allure of lower initial payments without understanding the potential consequences. If you're considering an RM, make sure you're not just chasing the lowest payment, but crafting a solid long-term plan. Watch out for hidden traps and always keep a safety buffer. Remember, your home is more than just a monthly payment. It's a place to build memories, raise a family, or retire in peace. Don't let a hidden mortgage clause turn your dream home into a financial nightmare. At Brickstart, our mission is to empower you with the knowledge to make smart decisions about your home and your money. Thanks for tuning in this week. And here's to making smarter decisions together. See you next time.